All right, welcome to The Explainer. Today, we are bridging a massive gap, the one between casual retail trading and the incredibly rigorous standards of professional wealth management. If you've ever found yourself wondering where the actual dividing line is between a savvy individual managing their own money and a registered investment advisor handling millions, well, you're in the exact right place. Let's dive in.
Here's our roadmap for today's Explainer. Section 1, From Retail to RIA. Section 2, Valuing the Future with DCF. Section 3, Fixed Income and Convexity. Section 4, the Fiduciary Mandate. And finally, Section 5, the Professional Standard.
We really have to start by asking ourselves a fundamental question. What actually transforms an everyday market participant into a legally bound financial professional? It's a pretty common misconception that it all comes down to having more capital or maybe just access to better trading platforms. But actually, scratch that. The real answer is far more structural than just the tools you use.
It really comes down to two dual pillars in our industry. On one side, you have the technical valuation skills required to analyze an asset, and on the other, the ethical mandate that governs exactly how you act on that information. A retail investor might look at a stock chart, get a gut feeling, and guess where it's going. But a professional operates within a strictly defined RIA framework. That means they require quantitative rigor to make the decision, and they have an absolute overriding legal responsibility to the client when they actually execute it.
Section 1, From Retail to RIA. Let's take a look at how this builds from the literal path of the Series 65 exam, which is the foundational test for investment advisor representatives.
So to pass the Series 65, a professional literally has to master these foundational analytical methods. They are quantifying everything from the time value of money to risk-adjusted performance. For example, you have to understand the capital asset pricing model, or CAP, because it leads directly to metrics like Jensen's alpha and the Treynor ratio. And guys, these aren't just fancy buzzwords. They are required mathematical tools used to isolate the exact portion of a portfolio's return that's explained by market risk rather than just sheer company-specific luck.
Section 2, Valuing the Future, DCF. Now we take those analytical theories and apply them to project future value. Assuming there is no arbitrage out there, meaning no risk-free way to just magically trade profitably, discounted cash flow, or DCF, gives us a mathematically sound way to evaluate expected return and future cash flows. The fundamental theorem of asset pricing basically dictates that a stock's price is the discounted value of its future price and dividend. Doing this right requires utilizing the stochastic discount factor, which honestly is just a highly technical way to account for both time and risk in those future payouts. It is the absolute bedrock of figuring out what an equity is worth today based on what it's going to generate tomorrow.
Section 3, Fixed Income and Convexity. Equities are really only half the story. So let's shift gears to the quantitative rigor behind bond valuation, which is notoriously tricky. Now, adjusting for convexity is absolutely critical. Why? Because it improves an estimated price change for a bond way beyond just using a simple modified duration. Duration gives you this nice straight-line estimate of how a bond's price reacts to interest rates. But reality isn't a straight line, is it? It's a curve. Positive convexity means that as yields change, a bond's price is going to increase at a much faster rate than it decreases. To truly gauge systematic risk, the Series 65 demands a deep understanding of these exact fixed income factors. You can't just look at the coupon rate and call it a day. You have to really understand yield to maturity, which assumes every single payment is reinvested at that exact yield, alongside duration, the coupon, and whether the bond is priced at par, premium, or a discount. All of these moving parts combined determine how that asset will behave when the broader economy shifts.
So let's put this math to the test with a real-world scenario. What actually happens when interest rates shift by just 50 basis points? Half of 1% might sound like absolute peanuts to a casual hobbyist, but to a professional, it changes everything.
This is convexity literally in action. It proves that evaluating interest rate risk isn't just some linear guessing game. Check out the math. If rates rise by 50 basis points, the bond's price drops to 105.3%. But if rates fall by that exact same 50 basis points, the price rockets all the way up to 111.0%. The upside price movement is significantly greater than the downside price movement for the exact same change in yield. That asymmetry right there, that's positive convexity. And calculating it is a mandatory skill if you're an RIA protecting a client's capital.
Section 4, the Fiduciary Mandate. But doing the math doesn't automatically make you an RIA. Valuation tells you what the asset is worth, sure, but fiduciary duty dictates exactly how you must act on it.
Established by SEC Interpretive Release IA 92 and the Advisors Act, this historical mandate carries uncompromising legal weight. It prevents any practice that operates as a fraud or deceit upon a client. It makes it explicitly clear, if you are providing investment advice as a business for compensation, you are bound by this. There's no loophole. You cannot indirectly do what is illegal to do directly. And the U.S. Supreme Court backs this up, making it crystal clear. Failure to disclose material facts is outright fraud. Why? Because commercial secrecy is exactly where predatory practices thrive. As an advisor, you owe your clients an affirmative duty of utmost good faith. If there is even a potential conflict of interest, you have an absolute obligation to disclose it so your client can make a fully informed decision. No secrets, no hidden agendas.
Section 5. The Professional Standard. So for our final section, let's see how all this theory builds into the everyday compliance requirements of an RIA. How do you actually prove you are upholding that utmost good faith?
To satisfy the fiduciary obligation in the real world, an advisor has to methodically draft and deliver a Form ADV Part 2 brochure. The SEC requires this to be written in a plain English, narrative format. So it's not just checking boxes on a form. You have to thoroughly explain your business practices, your review of accounts, and fully disclose any material conflicts of interest. The whole goal is ensuring clients can give fully informed consent.
Here's the real kicker, though. The fiduciary mandate is not a one-time signature you grab when you onboard a new client. It is an ongoing, living obligation to their financial well-being. Take a look at that third bullet point. Even between your annual updating amendments, if there's a material change to your advisory relationship or say a new conflict of interest pops up, you are legally required to disclose it immediately. You have to constantly seek to avoid conflicts, and where you absolutely cannot avoid them, you must illuminate them completely.
So, as we wrap up this explainer, I want to leave you with a final thought about who is truly qualified to manage your future. We've walked through the dense mathematical theorems required to accurately value equities, engage fixed income risks, and we've unpacked the heavy, ongoing legal burden of the fiduciary standard. Knowing all of that, looking at your own financial path, you really have to ask yourself, is your portfolio being guided by retail guesswork, or is it governed by the professional standard?